Welcome to the world of Mark's Money Mind, coming to you from the Rocky Mountain town of Crested Butte, Colorado. I'm your host, Mark Troutman, CFP. This educational, personal finance show combines money lessons, timely topics, personal stories, and community wisdom to help listeners and viewers master their finances to enjoy a stress-free life of financial freedom. In this episode, I thought I would talk about a concept I like to think of as the financial order of operations. My daughter has asked me on occasion when some of her friends asks, where do I start? They mention things like, should I be saving in an emergency fund? Should I be paying off my credit card debt? What about my student loans? How about a retirement plan at work? What is an HSA? What about this Roth IRA or traditional IRA? There are so many different things to consider. Where do I start? And so I came up with an idea that I like to think of as a financial order of operations. In other words, an order of priority for things that you can do. Because of course you can't do everything all at once. There is usually a logical order of tackling certain things first and doing other things later. So I thought I would talk about that in this episode. There are a handful of things that you can do, and there is usually a pretty good idea of an order to do them in. So the first thing I like to ask someone is, do you have any credit card debt? And depending on the answer to that question, there's going to be a couple of things to do in priority order. Some people would suggest pay off the credit cards, do that first, and don't do anything until they're all gone, depending on how much credit card debt there is, and also thinking about some other priorities. My opinion is that absolutely pay off the credit card debt, but there are also some other things you can do at the same time. And those two things are start building your emergency fund. And if you have credit card debt, I would suggest starting off with a very small automatic contribution to an emergency fund. And I like to use accounts such as a high yield savings account. So maybe not a savings account at your local banking institution if you bank locally, but find a high yield savings account, typically online, that will pay a much better interest rate than you would expect to get at your local bank, for example. I personally like Ally Bank. I have no affiliation with them whatsoever. It's just the bank I use. And the reason I like them is because they give you the ability to create separate savings buckets as part of your one savings account. So you don't have to open separate savings accounts for each different priority you may have for a savings goal, for example. I believe there are other institutions out there that also allow that, but Ally is just the one that I use and am familiar with. I also like their interface. People ask me, what account do I use? That's who I use, and I have found it to be very beneficial. I'm a huge fan of automation, and I would set up an automatic contribution to a savings account in conjunction with, say, the date that you get paid, maybe the day after, to give yourself just a little bit of leeway, or potentially many employers allow you to direct deposit to more than one institution. So you could split your paycheck, for example, between your regular checking account, which you use for your everyday expenses, and then a small amount to this emergency savings fund. And then it gets funded automatically out of your paycheck. If you have credit card debt, I would do it with a very small amount because it's going to be more beneficial to be putting a larger portion of your paycheck towards paying off that credit card debt. And we'll get to that in a moment but at least get the emergency funding mechanism started with an automatic payment. And then the question people have is, how much should I have in my emergency fund? The financial planning community will use a rule of thumb, and in this case, I agree with this rule of thumb, of somewhere between 3 and 6 months of your expenses. I like to think of it as base living expenses. So we talked about tracking our expenses in a previous episode. If you've done that, you should have a pretty good understanding of what your monthly expenses are on a consistent basis. And I would look through that list and look at the items that if you did not have a paycheck, if you were not getting paid, what expenses would you need to make sure are covered going forward? So those would be things like rent or your mortgage, your utilities, your groceries, and things of that nature, your base living expenses, things that you need to pay for even if you were very limited on funds. And then take 3 to 6 times that monthly amount, and that is a good target for your emergency fund. If you're starting off small, it will take you some time for sure to fully fund that account. So maybe set a goal of 24 or 36 months to fully fund your emergency fund if you have credit card debt. If you do not have any credit card debt or high interest debt, then I would shoot for somewhere in the neighborhood of completing it in a 12-month time span. Now, this is a good time of year to be contemplating this because there is a good chance that you may be getting a tax refund. So that may be a source of funds to jumpstart your emergency fund and put at least a portion of your tax refund, if you're getting one, into the emergency fund to get a head start on this goal. The second thing I would do, even if I had credit card debt, would be to sign up for my employer retirement plan. And most employers that offer a retirement plan, so that might be something like a 401k or a 403b, are going to have some type of matching component. A typical matching program would be, let's say you contribute 6% of your paycheck and they match 50 cents on the dollar for every dollar you put in, up to 6%. And so if you put in 6%, they're going to put in 3%. That is a instantaneous 50% return on your money. So I would not forego that option if it's available to you. So if you have a retirement plan at work that offers a match, even if you have credit card debt, I would contribute the amount required to get the full match. Now, the next question people ask is, okay, great. I have a retirement plan and I've decided to contribute to it. Where does that money go and what is it doing in that account? So typically you are going to have to either select an investment option or one may be automatically selected for you if you don't select one yourself. In most cases, that is going to be a target retirement date fund of some type, which is a combination of stocks, bonds, and potentially cash based on the year you expect to retire. And typically that's based on the age of 65. And that target date fund would be pre-selected for you. Now, most 401k plans and frequently 403b plans will allow you to select an alternative option. So you may want to look down the list of funds that are available. And personally, I would select a low-cost index fund as my option. And the younger I was, the more aggressive I might be in that account and potentially have a higher or potentially even all equity weighting if I was very young. One book that is very good to read that talks about index funds and how to choose them and what to look for is a book called The Simple Path to Wealth by J.L. Collins. Highly recommend you read that book, and not just if you're investing in a retirement plan at work, but for anyone interested in financial independence. I think it's an excellent book. And it talks a lot about index funds and the value of them and so forth. So I would recommend you read that book, and I'll put that in the show notes. Do those two things in conjunction with each other at the same time, aggressively pay off that credit card debt. I like to think of it as hair on fire situation. Rates on credit cards today exceed 20% per year, and in many cases are nearly 30%. These are very, very high rates of interest, and there is no investment that you are going to earn consistently anywhere close to 20 or 30% per year on a relatively guaranteed basis, because if you pay your credit card off, you get, in essence, guarantee you will at least avoid that negative rate of return. So effectively, you're getting a 20 to 30% return on any funds that you are paying down. So that's step one. Fund your emergency fund with a small amount. Contribute to your employer retirement plan to get the full match, and aggressively focus on paying off that credit card debt as quickly as possible. And we will talk in a future episode on kind of the order of operations on paying off debt, but that would be the next thing to do. Now, once your credit card debt is eliminated, then you could start focusing on other debts. I wouldn't necessarily just focus on those without thinking about some of the other things we're going to talk about contributing to. But if the rate is over 7% on other debts, then I would highly prioritize those, because that is a fairly high rate relative to what you could earn on investments, for example. So I would look at any auto loans you have, any home equity lines of credit, any personal loans, student loans, etc. And if the interest rates are over 7%, I would focus on paying those off fairly aggressively as well. Any debts below 7%, I might consider just paying at the standard repayment schedule and start looking at some of the other things that we're going to talk about next. So the next order of operations, so this brings us to step 4, that would be to increase the amount you're contributing to your emergency fund to get it completely funded within a 12-month period. So make that a priority. Then I would also consider saving for some non-retirement savings goals. I probably wouldn't put more than 5 or 10% of my income towards those, but I would prioritize those as well. Things such as a vacation savings account, a car replacement fund. So the next time you need to buy a car, instead of borrowing money to buy the car, you could buy the car in cash, or at least a majority of it in cash. And then I like a general fun savings bucket for entertainment activities and things of that nature. My experience is that saving in a vacation fund as a standalone goal is beneficial, because for a couple of reasons. One is it gives you something to look forward to. You see money going into this account. You can start to get excited about where you might be able to go on vacation, given the funds that you've saved. And then also when you're on vacation, you're not worrying about, how am I going to pay for all this when I get back home? It's already pre-funded. You can enjoy your vacation, and it'll also keep you from overspending on your vacation because you have allotted a specific amount for that objective. And then after that, so step number 6 would be funding a HSA or health savings account if you are enrolled in a health insurance program that is HSA eligible, and your medical insurance program will typically specifically state whether it's an HSA eligible program, or if you're getting it through work, you can ask your human resources department if the plan is HSA eligible. And if it is, you can contribute to an HSA account. If it's associated with your employer, frequently the employer is going to offer an option to contribute to that HSA directly from your payroll. And if you do that, you can avoid paying FICA taxes on those contributions. So that's an additional benefit by contributing to the HSA directly through your employer. The maximum that you can contribute to an individual plan in 2024 is $4,150. And if you have a family plan, you can contribute up to $8,300 per year. And if you're 55 or older, you can add an additional $1,000 to those amounts. It's considered a catch-up contribution. And I like to think of the HSA as a super Roth, and we will get to what a Roth IRA is in a few steps later. You get a tax deduction for the contributions. The money in the account, it may be invested in just cash investments, but it can also be invested in more aggressive things like equities or bonds. The earnings in that account accumulate tax-free, and any distributions from the account that are qualified medical expenses, there's a broad spectrum of items that are considered eligible medical deductions that you can withdraw from your HSA for. And here's the kicker. You do not have to take the distributions in the year that medical expense was incurred. So you can save all the receipts, let those funds continue to grow in that account for a long period of time, and then down the road, reimburse yourself for those medical expenses that you have the receipts for. So in essence, this HSA is triple tax-free. You get a tax benefit on the way in. The earnings and growth are tax-free as long as they're used for qualified medical expenses, and there's no tax on the distribution for those qualified medical expenses. Then the next step would be to see if you have a 457 plan. And you will see these in institutions such as municipal governments, state governments, local governments. This is a deferred compensation plan, which acts very similar to a 401k or a 401a or a 403b, but it's in conjunction with those. So you may have a 401k, a 401a, or 403b, and a 457 plan. And the way they work is that the contribution limits are separate and distinct from the amount that you can contribute to that 401a, 403b, 401k, and the limits are the same amount. So the maximum you can contribute in 2024 is $23,000. And if you are age 50 or older, you can contribute an additional $7,500. And the benefit of the 457 is that because it's a deferred compensation plan, if it's a traditional version of this, you get a tax deduction for any contributions that go in. And then when you take them out, they are taxable. But as long as you separate from service, you have full access to that account, even if you're under age 59 and a half. Now, 59 and a half is the magic age where typically you have to pay a penalty for early distributions from things like a 401k plan, a 403b plan, a Roth or traditional IRA. But the 457 does not have that penalty. So as long as you separate from service, you have access to those funds. So this is a very good option, especially for people who are considering retiring early and earlier than age 59 and a half. Then the next item or order of operations would be to contribute to an IRA, and that could be a traditional IRA or a Roth IRA. And in the traditional IRA, you get the tax deduction for the contributions, but when you take the money out down the road, you have to pay tax on all the distributions. In the Roth IRA, you do not get a tax deduction on the contributions, but when you're able to take money out down the road, there is no tax on any withdrawals. There is a 10% penalty, like I mentioned previously, if you take it out before age 59 and a half. but not afterwards. There's also another advantage to the Roth IRA in that you can always take out your contributions at any time without tax or penalty. Whereas the traditional IRA, those contributions, if you were to withdraw them, they would be subject to tax because they have not been taxed yet, and penalty if you took them out before age 59 and a half. So the Roth IRA is very advantageous because you always have access to those contributions without tax or penalty. Now, the maximum that you can contribute to an IRA, regardless of it's a traditional or a Roth, is $7,000 per year. Unless you're over age 50, you can contribute an additional $1,000. Now, that $7,000 or $8,000 if you're 50 or older is a combination of traditional and Roth. You can contribute to both traditional and Roth, one or the other, whatever your choice is. But the maximum you can contribute is a combination of the amount you contribute to each one of them. And there are also income limits, whereas with the 401k and 457, there aren't any income limits. HSAs, there are no income limits. The IRAs do have income limits. So I will include a link to the 2024 important tax numbers, which I've linked to previously, and it includes the limits you can contribute to each type of account and also the income limits where those contributions are no longer permitted. So for a traditional IRA, if you're single, you can contribute the maximum if you earn less than $77,000. Or if you do not have a retirement plan at work. And if you do have a retirement plan at work, the limit to where you can make the maximum contribution is $77,000, and it fully phases out at $87,000. If you make over $87,000, you can no longer contribute to a traditional IRA and get the tax deduction. In the Roth IRA, the income limits are higher. So for a single, it's phases out starting at $146,000 and fully phases out at $161,000. For the traditional IRA, if you're married filing jointly, the income phase out is $123,000 and it fully phases out at $143,000. And for the Roth IRA, the married filing jointly phase out starts at $230,000 and fully phases out at $240,000. And these are all for 2024. So let's say you've funded your emergency fund, you've done your HSA if you can, you've taken advantage of a 457 if it's available to you, you've contributed to your IRAs, whether it's traditional or Roth. Then you could go back and start to look at your employer retirement plan. Previously, we talked about just putting in enough to get the match. You can contribute more than you would need to get the full match. And the employer plan, if it's a 401k or 403b, the maximum annual contribution is $23,000. If you're 50 or older, you can contribute an additional $7,500. And then the next order of operations would be a brokerage account. And some people may choose to contribute to a brokerage account without waiting until you've completed all the prior steps. Maybe you would like to do it in conjunction with some of the prior steps. There's no tax deduction for making contributions to a brokerage account, but there are some advantages. One, the money is accessible at any time. So that's certainly an advantage. And the other thing is that if you have qualified dividends and or long-term capital gains, they get preferential tax treatment. You can pay as little as 0% on qualified dividends and long-term capital gains if your income is effectively in the 10 or 12% bracket. There is a slight nuance to the limits. It's a few $100 difference than the actual 12% bracket limit, but that's taxed at 0. The next bracket is up to 15%. So you may only have to pay 15% on qualified dividends and long-term capital gains. And then ultimately at very high income levels, you may have to pay 20%. And then there's also the net investment income tax, which kicks in if you're single at $200,000 or more of income and married filing jointly at $250,000. But still, that is going to be significantly lower than the tax bracket for your normal income given those amounts. And then there's one other type of account that you may want to consider doing, and that is if you have a child, for example, or you want to fund education for a relative, and that would be a 529 plan. And again, many people might do this in conjunction with some of the other funding choices that we've already outlined. The 529 plan has a potential state tax deduction. There's no federal tax deduction for contributions, but your state may offer a state tax deduction if you contribute to your in-state plan. The earnings in that account are tax-free if the distributions are used for qualified education expenses, and those would include tuition, room and board, books and supplies, even things like computers for school if they're required. In addition, and I mentioned this in a previous episode, in the Secure 2.0 Act that was recently passed, you can take excess amounts that are left over in a 529 plan and convert them to a Roth IRA for the beneficiary of that 529 plan up to a maximum of $35,000, provided that the account has been open for 15 years and none of the money that's being converted was contributed to the plan within the last 5 years. So there are some nuances to it, and this is in lieu of a contribution that you would ordinarily make to that Roth IRA, and that person must have earned income to substantiate the contribution. So this is how I think of the financial order of operations on how I would walk through funding different account types and the order of preference. And so let me just go over them real quickly here. Step 1 would be to fund an emergency fund with a small automatic amount. Step 1B would be to also enroll in your employer retirement plan enough to get the full match. So those two are in conjunction with one another. The next step, step 2, would be to pay off credit card debt because those rates are typically in the 20 to 30% range. Step 3 would be then to look at other debts, especially those that exceed 7% in interest rate. Step 4 would be to increase the amount going to the emergency fund to get that goal completely funded within a 12-month period. Step 5 would be to consider non-retirement savings goals, things like vacation, car replacement, fund bucket. Step 6 would be to fund an HSA if you're eligible to do so, a health savings account. Step 7 would be to take advantage of a 457 plan if you're eligible. Step 8 would be to fund a Roth or traditional IRA or a combination of the two. Step 9 would be to go back to the employer retirement plan and increase the contributions potentially to the full maximum. Step 10 would be to fund a brokerage account. And step 11 would be to fund a 529 plan if that is suitable for you and or your family. And the one thing I would like to add about Roth or traditional, some people will ask me, should I be contributing to the Roth or the traditional version of my 401k or IRA or 403b, for example, or even 457? And I like to think of it this way. If I'm in the 10 or 12% tax bracket, I would definitely go Roth, and that's just me. But at that tax rate, I think it makes a lot of sense to just go ahead and pay the tax at that low rate and then have the money available to you down the road tax-free. In the next two tax brackets, 22 and 24, it starts to become a judgment call. But personally, I think it's still very beneficial to contribute to a Roth if you're in the 22 or 24. Historically, those are very low tax rates. So in my opinion, I think it's beneficial to still contribute to the Roth, even if you're in the 22 or 24. Once you get beyond the 24% tax bracket, then I start to lean towards the traditional. And the reason is because the tax rate is obviously higher. You may also be paying state income taxes on top of that. And there is a chance that down the road, you may have an opportunity to do Roth conversions from those accounts at a lower tax bracket, especially if, for instance, you decide to retire early and or even retire on time, let's say in your 60s, but are not required to take distributions from your traditional IRA until age, in most cases, 75 now. So you would have this tax planning window to do conversions at potentially lower tax brackets than tax brackets that would exceed the 24% bracket. So that's how I think about Roth versus traditional. I also like the idea of having tax diversity. So having some money in traditional, some money in Roth, and some money in brokerage, I like to think of as maybe taxable because the contributions to a brokerage account are not taxable. Obviously, you can take money out anytime you want, and those dividends and long-term capital gains but could potentially even be taxed at zero. So it's maybe taxable. The idea of tax diversification gives you various levers to pull down the road. Like, for instance, myself, I'm in the retirement mode. I do not have an income, but I pull from different accounts, and I can choose to pull from my Roth IRA and pay no taxes. I can choose to take money out of a savings account where most of it is principal. So pretty much all of those assets are available without any tax. Or I may choose to take money out of a retirement account. I would need to wait until age 59 and a half in order not to be penalized. But if it's an inherited IRA, you could take money out pre 59 and a half without penalty, but you will be paying tax on it. So I like the idea of having tax levers in retirement. So having a mixture of all the different accounts. Now, the one thing that you will find is that typically if you have an employer retirement plan and they're doing a match, even if you're contributing to the Roth version of that 401k, for example, the match is usually going into the traditional component of that 401k. So by having a contribution to your Roth 401k, for example, you still do have tax diversification because the match is going into the traditional component in most cases. So that's how I like to think of the financial order of operations. I hope this was helpful. I hope this gives you an idea of where to start and how to think through this kind of cascading process of where to put your money. And especially if you're just starting out, I hope this was beneficial because this is a question that I get a lot from people who are just starting out, whether they're starting out on their own journey because they just started working or because they have just started to learn about the idea of financial independence or saving and investing, and they don't know where to start. Thank you for listening to this week's show. Please click follow on your favorite podcast player or subscribe on YouTube to ensure you don't miss any future episodes. Also, please leave a rating and review for the show. This helps improve the ranking and enables other like-minded people find the content in their podcast players. If you would like me to answer a question on the show, please send it to mark@marksmoneymind.com and put podcast question in the subject line. Let me know your first name, or let me know if you would like to remain anonymous, and also your state of residence if you choose. I would also appreciate it if you would recommend this show to friends and family that might benefit from this content. See you next week on the Mark's Money Mind Show. Until then, Make some, save and invest, live on the rest. And now for the all-important disclaimer. This show is for education and entertainment purposes only and should not be considered investment, tax, or legal advice. Please consult the appropriate advisor or advisors before implementing anything you hear on this show or any other show for that matter. While I fully intend for everything on this show to be true and accurate at the time of each recording, occasionally errors may occur. So please do your own due diligence on anything discussed.